Hello and welcome to my morning note. If you've been reading the FT recently, you'll be aware that emerging market assets have had some rather horrible things happen to them recently. The question I'd like to try to answer today is whether that's due to problems in the emerging markets themselves, or whether it perhaps has more to do with shifts in the underlying financial tectonic plates of the developed world. With me now to discuss this is our economics leader writer, Martin Sandbu. Martin, thanks for joining us as a guest rather than a host.
Thanks for having me.
Let's start by taking a look at how emerging market stocks have done compared to the developed world, and how the Indian rupee, which is perhaps the classic emerging market carry currency, is doing compared to the dollar. What's going on here?
Well, I think one thing that's really interesting here is how correlated these two lines are. The red one is stock market performance, the blue one is the currency, and you could probably pick a lot of other emerging market indices and you'd find the same thing. Other currencies have been falling, like the rupee. So what does that suggest? Well, it's really a huge generalized carry trade. It's not so much discriminating between different factors in emerging markets as this wall of money that has leaked out of developed countries and hit the emerging world. And that seems to be what is now reversing.
Okay, and so the emerging markets again tend to be the derivatives or the innocent bystanders, the collateral damage for things that are happening in the developed world.
Well, I think that's something we'll see once we just remind ourselves how big the changes have been in the developed world.
And on that note, let's take a look. The bond market is always about as important an underpinning as you'll get. What we're looking here for changes at the very long term, both Treasury yields and German Bund yields.
It's an astonishing chart, isn't it? Because back in the 50s, of course, that was the era of financial repression. Yields were low everywhere, partly
there was an actual formal
policy.
Cap on bond yields.
In the US, there was this agreement between the Treasury and the Fed. And we see that in the last couple of years, during the crisis, QE, extraordinary monetary measures, yields have been lower even than they were then. And it would just have been inconceivable with the sort of open global economy we have today that this wouldn't affect other markets. So that is, I think, the main story behind what's happened in emerging markets over the last couple of years, including the generalized fall in asset values over the last months and weeks and even days.
And just to make clear, because it's not very clear from such a long-term chart, there has been a distinct move upwards in yields in the last few weeks.
That thing here, of course,
Although in historical terms, plainly, it's not that significant yet. Now, let's try to explain why are those yields rising. You hear people talk about bond vigilantism, you can talk about economic optimism, you can talk about second-guessing the Fed. What is your best guess for why they're moving?
Well, I mean, if we think about this, it's natural to think that the normal lies sort of on the long-term average, right? So we're clearly still far below normal. There's still too much money relative to normal going into these haven assets. That seems to now be reversing, right? That's the flip side of what we see in emerging markets. Why is that? Well, there are two main stories, right? One is negative, one is positive. The negative one is inflation is on the rise. Let's get out of these nominal
But let's
assets.
quickly take a look at what the bond market is saying about inflation expectations.
So these are inflation break-evens. So that's the difference between the yield in nominal bonds and those that are inflation-proof.
Basically suggests that the market is less worried about inflation now than it was a matter of weeks ago.
So it's been
both
going down
Germany
here,
and the US.
it's been going down here. So that indicates to me that it's not the negative inflation fear story. Rather, it's a positive story. Because what does this mean? Investors are thinking yields are going up, but inflation is going down. Well, that sounds like a growth world. Productivity may be going up, less pressure of inflation, but a withdrawal of monetary stimulus. That actually sounds like a pretty nice looking world. So this might be optimism coming back.
Okay. First of all, do we really believe that? And secondly, isn't it a little harsh on the emerging markets that part of the process of normalization or even Goldilocksization of the developed world is that their assets take a tumble?
Well, I think it is possible that this is going on, that we are finally, we're starting to see more and more good news, still small trickles, but in the US it's quite clear that things are turning a bit better. In the UK we've had some good news recently. In the Eurozone, well, at least things haven't looked as bad as they did last year. It's all relative. So I wouldn't rule it out at all. I think it's eminently possible that we are seeing, ongoing good news. Is it harsh on the emerging markets? Well, they did get a boost from from the policies that happened before. But in the long term, I think growth in the developed world is also good for the emerging markets.
Okay, Martin, thank you very much indeed. In a very strange kind of a way, we seem to have persuaded ourselves, therefore, it could almost be good news for everybody in the long run that emerging markets are falling like this at the moment. It is a symptom of a belief that the developed economy is normalizing. Let's hope that belief is correct.